ultimately the value of an asset is the discounted future cash flows based on the risk and the return required by a purchaser. And often for different businesses that's difficult to establish. So for an early stage business, for instance, an early stage technology business, there's a high degree of uncertainty about the future cash flows, and so it's very difficult to formally do a cash flow out for the next 10 years. This is going to be our revenue, these are our costs, and reliably estimate those for most businesses in an early stage is virtually impossible. So typically what happens with early stage businesses is the market develops some rules of thumb to value those businesses. And back in the 90s, technology businesses were being valued based on eyeball time, and that was some estimates around the amount of eyeball time. Correct, yeah. And now we're hearing talk of valuation based on number of developers. So a company that's got 10 developers, there might be a multiple applied based on number of software developers. Now, obviously, that doesn't have any direct connection that we can see to what the value of the asset being linked to future cash flows, and that's the investment that we're making to buy those future cash flows. But it is a proxy for what the market views as a potential of that particular business to generate those cash flows in the future. Right. So
is that based on histories of early stage fast growth companies, the ones that have been more successful, the ones that have had the developers?
Correct. Yeah. So there would be recently transactions where people have looked at those transactions, and there might have been 10 developers, and they valued that business at $10 million. And so then people have looked at similar businesses in that sector and saying that, well, we should look at a similar metric to value those businesses as well. So they might be social media businesses or online payment businesses. There's all sorts of. Yeah.
So it's all a judgment on the factors for success. In this particular case, they've identified that developers are a key factor for success in early stage tech companies.
Correct. Yeah, I think there's obviously underpinning that. There's a lot of other factors that drive that, such as position, market entry strategy, barriers to entry, how defensible is their position once they get established in the market. Those sort of factors all feed into it, into that assessment. But ultimately, that's sort of how the calculation's done. And so that's an example of a rule of thumb. Lots of industries have different rules of thumbs. Financial planners is a multiple of revenue is often how those businesses are valued. Accounting firms are a cents in the dollar of revenue. So there's lots of different industry rules of thumbs depending on what industry you're looking at. Yeah.
So for trade sales, almost industry by industry, you can see a value quite well using those rules of thumb.
Yeah, I think it's slightly different for more mature businesses, because with a more mature business, it's easier to go to a more traditional valuation model, which looks at and even a multiple of earnings is another sort of shorthand method to get to a future cash flow calculation. So often at the moment, people will hear businesses selling for 4 times EBITDA, which is earnings before interest, tax and depreciation. And so that methodology is usually used for a more mature business, and so where it's more predictable and it's more into a steady state going forward.
And EBITDA is also part of that multiple when there's a listed company taking over an unlisted company, isn't it?
Correct, yeah.
It can actually make money out of the purchase, can't it?
Correct, yeah. With there's what's called multiple arbitrage, where a listed company might be trading on the stock exchange for 8 or 9 times EBITDA, and they're buying business at 4 times EBITDA. So they get an immediate value uplift when they make that acquisition. So that's without any synergies or cost savings. There's an immediate benefit there for the company making the acquisition.
So someone trying to sell a business, even an early stage, would seem to want to drift in that direction to go for that sort of a trade sale, wouldn't they?
Exactly, yeah. It's part of optimising the process on an exit. The best buyer is someone who's prepared to pay a strategic value for the business,
Yeah.
and that strategic value might come from the fact that they're listed and they're able to offer a higher price because their stock's trading at a higher multiple.
Mm-hmm.
It might also be that the purchaser can take the product and sell it to all their existing customers and
Mm-hmm.
immediately grow the revenue
Yeah.
just through their own existing business. So there's or there might be cost savings as the other obvious advantage sometimes in an acquisition for the purchaser. And so the purchaser then may decide in order to access the acquisition, they will then pay a premium above what another purchaser might pay.
Which is an ideal situation if you're selling.
Exactly,
obviously.
yeah.
So in Interfinancial's more recent experience, which way are you seeing these valuations drift? Is it industry dependent or is there some sort of trend?
I think, look, there's definitely a trend towards sectors running hot and cold, and
Right.
and as we saw in the late 90s, technology went very hot, and we're seeing that again at the moment. So technology is definitely a flavour of the month, and a lot of the technology companies are trading at very high multiples, and that enables them to pay high acquisition multiples as well. So if you're a technology company looking to exit right now, you'd be thinking hard about, am I going to get, is this a good time to go because I'm going to get a high value, and so I should be thinking about it. Other sectors that are attracting high multiples at the moment are health and aged care and areas like that where the market's very keen on acquisitions in that space, so the price rises as a result.
And Interfinancial's got a lot of experience in food and agribusiness as well, hasn't it?
Correct.
How's
yes.
that area going?
Well, that's another area that's showing very, very keen interest from overseas buyers, and that's been driving up the price. Certainly in the processing space, we've seen a lot of the sugar refineries purchased by overseas buyers at high multiples. We're seeing that in the dairy and the processing area, and also now with beef. So certainly strong interest there, and so as a result, prices tend to rise.
So that's at the agricultural area. What about the food processing areas? Is that experiencing the same thing?
At the export side of things, it is. I think if a food processor is heavily dependent on Coles and Woolworths, then there's still reluctance amongst buyers to pay a premium for those sort of businesses because they're concerned about the ability to manage those relationships, given there's a power differential there, and often the supermarkets are keen to keep prices down, and that affects the processor's capacity to get better margins.
In your engineering area and mining services, there's a lot of talk about a bit of an uptick in the manufacturing area. How are you seeing that playing out in terms of mergers and acquisitions?
Well, I think with equipment-related businesses, what we're seeing is it's still very difficult to sell those businesses, because what's happened as a result of the slowdown in mining, we've now got excess equipment capacity, and that's driven down the hourly rates that equipment's been able to be hired at, and also the resale prices. So that's really triggered a bit of a slowdown and a value reduction in that particular space. So I think specialist manufacturing with good technology, is always going to do well, and I think that there's still some companies in Australia doing well and exporting mining technology overseas. But generally, obviously, the mining companies have reduced their capital expenditure, and that's reduced demand. So as a result, I think most companies in that sector have seen a slowdown.
Is the Aussie dollar drop helping that sector?
I think that it is, and I think that as it drops further, as they're predicting, it should help the manufacturers. Obviously, there'd be a bit of a lag from them retooling and re-establishing, but there should be some growth there for the economy going forward.
Do you see that effect on those industries when the Aussie dollar drops? International companies then start to look at buying here?
I think we do. Surprisingly, we saw reasonably high levels of cross-border acquisitions even when the dollar was quite high. And so it didn't seem to drive their decision-making. It was more about strategic decisions to get into Australia, and a lot of especially American companies see Australia as a starting point to an Asian expansion.
Right.
And in the scheme of things, the Australian acquisition is probably not a significant acquisition for them, so they're really...
In terms of overall cost.
Yeah, correct, yeah. So I sold a business last year to a US company that was a $3 billion company, and they bought a $6 million company in Australia. So comparatively, it was really a minor acquisition for them, and it was part of a longer term strategy. So.
Have you seen into financials buying and selling and assisting companies with their mergers and acquisitions? Have you seen any sort of trend emerge in the last couple of years?
I think there's a couple of interesting things that have come out. I think one certainly we're seeing more risk sharing. There's certainly in the sectors that aren't doing as well. There's a reluctance by the purchaser to pay a full price up front. So what the purchasers will typically do is they'll say to the vendor, look, we're happy to pay you 5 times EBITDA, say, as a valuation, but we're going to pay you 4 times now, or pay the other one in a year's time, assuming that we hit these milestones. So we're certainly seeing more of that sort of deal structuring to cover off that risk.
Is that necessarily a bad thing for the Australian companies? I mean, they've obviously got some hurdles to jump along the way to get their full price. Yeah, no,
I think you could hold on for a better price, but ultimately, I think if you've got a willing buyer at the table, you should think very seriously about negotiating a fair deal. That covers, and we see those transactions as being well balanced for both sides, managing the risk for the purchaser and the seller getting a solid price.
Because it's not just about the changes in the market, is it? It's some of the risk is that the talent in that company needs to stay there to continue that performance, isn't it? Is that how they're using it to mitigate risk?
Yeah, correct. It can be for a number of reasons. One common one at the moment is that the vendors are saying, well, look, historically this business has done a lot better than it is doing at the moment, and we don't. If we're going to sell now, it's why we sell now, because the business has been through a difficult period, and so. To get a deal done, the purchaser's saying, well, look, we accept that the normal earnings of this business would be higher, and so we're happy to work with you to achieve that. The other one, as you mentioned, is that there's some key risks in the business. There might be a key relationship with a key customer. There might be some key person risk that needs to be, over time, managed to ensure that the business post-acquisition isn't significantly reduced as a result of the transaction. So there's all sorts of reasons to have that in there. The other might be in a technology company where they've been growing very strongly and the growth is likely to continue, is to get a full value in a high growth company. There needs to be some some earn out or some subsequent payments to make it a fair deal for the vendor.
When you look at around the place at the hopes that are coming from government, whatever, for jobs recovery in particular, it's all now starting to turn towards early stage, fast growth startups as being the area that needs to be pumped up and assisted. How are you seeing the sort of valuations of those businesses being assessed, or are they there seems to be almost a sort of fairy tale with a lot of those early stage tech companies of getting the big buyer from the States.
Yeah.
Is all that unrealistic?
No, I think America generally values companies higher. That's a reality. It is hard for an Australian company to make the step into the US market and get established there, but if they can get a US investor interested while they're still in Australia and facilitate the entry into the US market, that's obviously a great way to grow the business. You're looking at a population base in Australia of 20-something million versus 300 million, a much bigger market, much more opportunities, and for a lot of technology companies, getting into the US market is a key step in the commercialisation of their technology. So certainly important to do that. I think the Australian venture capitalist market has been growing recently, and we've seen a couple of new funds raised. As you say, the government's incentivising those early stage companies as well. I think in terms of valuing early stage companies, there's a lot more uncertainty about what the future holds for those companies just by their very nature, and so often those companies can be given a high valuation but with some downside risk for the investor. So the investor might use what's called a convertible note, where that note converts based in the future, say 3 to 5 years, based on the performance over that period. So there's some metrics in there that might allow for the investor to get a 25% return, and anything above that over that period goes to the founders. That sort of model. So they get the money now, and the valuation's set based on their performance over the next 3 to 5 years. So it's sort of a win-win for both parties. And a lot of technology companies need that capital to take them to the next level.
So in the case of a company that didn't reach the levels that its purchaser was after, would there be a rebate situation?
There would be, yeah. There's what's called a down round, or there needs to be a floor on what that would be. Obviously, the founders don't want to end up with 1% of the company at the end of the 3 to 5 years. So there needs to be some management around what's a reasonable deal for both parties, and how much risk should everyone be bearing in the deal. We recently completed a transaction for a technology company that was probably more advanced. It had just got to break even, but it was the investment happened through a convertible note, and that convertible note was the money raised through the convertible note was being used to address the US market. So it was being successful in Australia, but they were ploughing all the money back into developing it, and so the next step was to get into the US market, which was a lot bigger and a lot more lucrative, and that would get them into profitability.
It tended to be a pathway for just about all tech companies to head to the US and then head for IPO. Has that died back a little bit?
That was certainly the case in the late 90s, and a lot of NASDAQ listings happened during that period of Australian technology companies. I think it's a bit horses for courses, and where the logical head office is. We've seen some great success stories like Technology One, where they've kept their base here in Australia. For other companies, it might make more sense to go to the US and establish in the US.
Is that because of access to capital? Obviously market, but access to capital?
Yeah, I think so. If it's particular types of businesses, I think in Australia aren't well understood. And I think if the investment community doesn't understand it, then you're not going to get the support in Australia for that particular business. So often it's better to go to a market offshore.
There seems to be a real, still a gravitation to web-based companies in terms of these early stage startups.
Yeah.
Is that a bit unrealistic? So many of these companies heading into that space, undercapitalised, all hoping for the US buyout dream? Yeah.
Well, I think it's depending on what part of the market you're in. It can be very do or die, and it's very a binary outcome for a lot of those companies where they're either worth $5 billion or they're worth zero. So I think people need to be realistic about the potential outcome for them. The company that we recently raised capital for was a risk management company, and it wasn't a social media super duper company, but it was just doing some pretty mundane sort of stuff, but it was highly valuable to their customers, and they were sort of the best in the world at what they did. And as a result, it'll be a great success story for Australia in the future. So I think I think we need to be realistic about niches and targeting niches where we can defend our position and get established. I think if you're trying to go too big, you need to make sure you've got a pretty sharp strategy to be successful.
It seems that a lot of those companies that are successful in that area do so through, I've seen in some cases, buyouts of particular technologies that they can bolt on, but also collaborations seem to be a strong part of that. I'm thinking about companies like Big Commerce and that have done very well in a very short period of time.
With any startup company, I think good relationships are a key part of the ecosystem that builds the business, and often that might result in acquisitions. We've seen MYOB as a technology company recently making several acquisitions. We've got Xero Accounting in the market, which is moving very fast to establish a new paradigm around accounting software, and so MYOB's been moving quickly to make acquisitions to build their capability to counter the competitive force there. I think when you're a small startup, it's certainly a key part of developing the business is building key relationships to develop the capability that you're trying to achieve for the market.
Well, how do you see the role of incubators and some of the I guess they're incubators, but the KPMG funds and that are starting to come through with early stages?
Yeah, I think it's interesting. One of the new developments that we've seen are big corporates recognising that they're not good at developing technology because they squash it with their bureaucracy, and their risk management and their systems and processes just aren't suitable to breathe life into a early stage technology company. So what we're seeing is Telstra and big corporates, even some of the banks, have developed their own venture capital fund within the bank, within the company, and they're now using that money to invest directly into technology companies that they think ultimately will benefit their business. So that's that corporate venture capital is a great development.
Have we seen anything like that before?
No, it's relatively new. I think often historically big companies had their own research and development teams, and I think through some hard lessons they've realised that they've spent a lot of money and they haven't achieved the outcomes, and that they're better off targeting start-up early stage companies and putting capital into them, and the outcomes are better for both parties, I think.